In 1923, a German man borrowed enough paper marks to buy a large countryside estate. At the time, the loan was a heavy burden, something that would take him 20 years to repay. 6 months later, hyperinflation hit the Weimar Republic. The currency collapsed so violently that the man walked into the bank and paid off his entire 20-year mortgage with the money he earned from selling a single farm egg. This is not a fable. It is a documented historical fact. It is the phenomenon known as inflation-induced debt destruction. And it is the single most important concept you need to understand if you want to know what happens to real estate when a currency dies. Welcome to the Financial Coin Historian. Today, we are not talking about a standard market correction. We are answering the ultimate financial what if. What happens to American homes, mortgages, and rents if the US dollar truly collapses? Most people think a currency collapse means everything goes to zero. They are wrong. In a collapse, real estate doesn't disappear. It becomes the eye of the storm. But the rules of ownership flip upside down. Savers become losers, debtors become kings, and the price on your Zillow app becomes a dangerous illusion. Drawing on the history of Germany, Zimbabwe, Argentina, and deep macroeconomic research, we will construct the timeline of a dollar collapse and reveal why your mortgage might be your biggest asset or your biggest trap. The counterintuitive truth: debtors win, savers lose. To understand the future, we must look at the mechanism of the past. The most shocking realization about a currency collapse is that it creates winners. The mechanism of debt destruction. When a currency collapses, it loses its purchasing power. This is a disaster for anyone holding cash. If you have $100,000 in a savings account and inflation hits 1,000%, your savings can suddenly buy only a week's worth of groceries. You have been wiped out. But consider the person who owes money. Imagine you have a $500,000 fixed-rate 30-year mortgage on a house. In a normal economy, that is a massive debt. But in a hyperinflationary collapse, wages and prices skyrocket in nominal terms to keep up with the dying currency. A loaf of bread might cost $100, a gallon of gas might cost $500, and your monthly salary might jump to $10 million a month just to keep you alive. Here is the magic trick. Your mortgage payment does not change. The bank contract says you owe $2,500 a month. It does not say $2,500 adjusted for inflation. So when your salary hits $10 million a month due to hyperinflation, you can pay off your entire 30-year mortgage with the spare change from your lunch money. This is exactly what happened in Germany in 1923. Historical records show that by late 1923, virtually all debts, including mortgages, were wiped out in real terms. Borrowers paid off houses with handfuls of worthless notes. The banks, which held these loans as assets, were destroyed. The homeowners, who held the physical asset and the fixed debt, effectively got their houses for free. The Hugo Stinnes strategy. This strategy has a name. It is often associated with Hugo Stinnes, a German industrialist who became the richest man in the country during the inflation. While others were saving cash, Stinnes borrowed massively. He bought coal mines, factories, ships, and real estate. He understood that the mark was dying. He paid his debts in worthless paper, but he kept the hard assets, the mines and the buildings, which retained their real value. His debt shrank to nothing. His empire grew to everything. In a hypothetical US dollar collapse, this dynamic would likely repeat. The 30-year fixed-rate mortgage is the American version of the Hugo Stinnes trade. It is a short position on the dollar and a long position on a hard asset. However, before you rush out to take on massive debt, you must understand the second phase of the collapse, the liquidity freeze. Just because you own a home doesn't mean you're safe. In the early stages of a currency crisis, the housing market doesn't boom. It freezes. The credit crunch. For the dollar to collapse, confidence must evaporate. When that happens, interest rates will not stay at 5% or 7%. Lenders, realizing that the dollars they get back will be worthless, will stop lending entirely, or they will demand interest rates that cover the inflation risk, rates of 20, 50, or 100%. We saw a mild version of this in the US in the late 1970s and recently in 2023, but in a collapse, credit stops. You cannot get a mortgage. This means no buyers. If you want to sell your house, you cannot find a buyer unless they have pure cash or gold, crypto. The pool of buyers shrinks from millions to a handful. Price distortion. Sellers will ask for billions of dollars for a home, but no one can pay it. Transactions halt. The market price becomes theoretical because no trades are happening. The maintenance trap. While your mortgage debt might be inflating away, the cost of owning the home will explode. Taxes. Municipalities will be broke. They will aggressively reassess property values to match inflation. Your property tax bill could jump from $5,000 a year to $50,000 or $500,000 a year. If you cannot pay, the government will seize your home for tax delinquency. Repairs. If a pipe bursts or the roof leaks, the cost of materials and labor will track inflation instantly. A simple roof repair could cost what a luxury car used to cost. Utilities. Energy prices usually lead inflation. Keeping the lights on and the house warm becomes a luxury. This leads to a phenomenon seen in Argentina and Venezuela: housing blight. People own homes, but they cannot afford to maintain them. Buildings crumble, elevators stop working, neighborhoods decay even as nominal prices hit record highs. We must distinguish between nominal value and real value. This is the trap that catches amateur investors. Nominal value, the price tag in dollars. In a collapse, your house might be worth $50 million. You feel rich. Real value, what that house can exchange for. Can you trade your house for a factory? For 10,000 ounces of gold? For a farm? In hyperinflation, the price of everything rises, but real estate often lags behind other more liquid assets like gold or food. Why? Because you can't eat a house. In Zimbabwe in 2008, people were desperate to convert cash into anything tangible: land, cattle, bricks. But real estate is illiquid. It takes months to sell. In a crisis where prices double every day, months is an eternity. Therefore, while your house preserves wealth better than a bank account, it is a poor instrument for buying groceries. You become asset-rich, cash-poor in the most extreme sense. A dollar collapse would trigger a brutal class war between landlords and tenants. The renters' nightmare renters are the most vulnerable group. They hold no hard asset. As the landlord's costs, taxes, repairs, living expenses skyrocket, they will raise rents aggressively. We could see rents resetting weekly or even daily, as happened in Weimar Germany. Unless wages keep up with inflation, which they almost never do in the early stages of a collapse, renters will face mass displacement. Homelessness would explode. Families would double or triple up in single units. The political response? Rent control governments will not sit idly by. To prevent riots, they will almost certainly impose strict rent controls. The trap for landlords. The government might freeze rents at pre-crisis levels. If inflation is 100%, but you can only raise rent by 2%, your rental income becomes worthless. Meanwhile, your maintenance costs and taxes are soaring. Abandonment. This leads to landlords abandoning properties. If the cost to run an apartment building is higher than the rent collected, the landlord walks away. This happened in the Bronx in the 1970s and in Weimar Germany. The housing stock degrades rapidly. The foreign buyer scenario. If the dollar collapses relative to other currencies, like the euro, the yuan, or gold, American real estate becomes essentially a fire sale for the rest of the world. Imagine the dollar loses 90% of its value against the Swiss franc. To a Swiss investor, a penthouse in Manhattan is now 90% off. We would likely see a massive wave of foreign capital swooping in to buy prime U.S. assets, farmland, skyscrapers, and luxury homes for pennies on the dollar in their currency terms. This creates a paradox. Locals are priced out and broke, while foreign entities buy up the physical nation. This happened in Mexico after the 1994 peso crisis and in Thailand after 1997. It is a transfer of sovereignty through real estate. Which real estate survives? Not all real estate behaves the same. History gives us a hierarchy of survival. Farmland, the gold standard of dirt. Agricultural land is the single best performer in a collapse. Why? Because it produces food, and food is the one thing people cannot stop buying. In Weimar Germany, while city buildings crumbled, farmers became the new elite because they could trade potatoes for gold, pianos, and art. Farmland has intrinsic utility. Residential, multifamily. People need shelter. Demand is inelastic. However, this sector is most vulnerable to government rent controls and eviction bans. Commercial office, this is the most dangerous. In a collapse, businesses go bankrupt, offices empty out, retail shops close. Commercial real estate relies on a functioning economy. If the economy stops, the value of an office tower can drop to near zero in real terms. Finally, we must consider how the collapse ends. It usually ends with a currency reset. In Germany in 1923, they introduced the Rentenmark, backed by land and industrial goods. In the US, if the dollar dies, a new currency will be issued. But here's the warning. The government may rewrite the rules of debt. While we said earlier that fixed-rate mortgages get wiped out, the government knows this destroys the banks. To save the banking system, the government might pass a law indexing old debts to the new currency or to inflation. This happened in Poland and other nations. They might say, your mortgage is no longer $2,000. It is now indexed to the price of gold. If that happens, the loophole closes. You don't get a free house, you get a new, harder debt. The lifeboat strategy. So, what is the verdict? Is real estate a shelter when the dollar collapses? Yes, but it is a lifeboat, not a luxury yacht. It will keep you afloat when the ocean of paper money drowns the savers. It preserves value better than stocks or bonds. But it comes with risks, illiquidity, high taxes, and the threat of government seizure or rent control. The ultimate lesson from history is this. In a currency collapse, ownership matters. You want to own things that are real. A house is real. A farm is real. A dollar bill is just a promise. And when the promises are broken, only the real things remain. This is the financial coin historian. We don't predict the end of the world, but we prepare for the end of the monetary cycle. Because history shows us that no currency lives forever.